All right, let's just dive right in. We're going to tackle a question that I know so many of you have thought about. What could really happen if you took a big chunk of money, let's say 100 grand, and just put it into simple, low-cost index funds for the long run? You know, the answer? It might actually blow you away.
I mean, just stop and think about that for a second. Your money working for you 24/7 even when you're sleeping. And look, this isn't some get-rich-quick fantasy. This is the real, tangible potential of long-term investing. It's about building a future where your money does the heavy lifting, giving you freedom and options.
So, to make this all feel a bit more real, let's meet John. Now, I know what you're thinking. Having $100,000 is not a problem. And you're totally right. It's an incredible accomplishment. The real problem is that it's just sitting there, losing its buying power to inflation every single day. The challenge is, what do you do next?
So what's John's situation? Well, he's 40 years old, and he has worked hard to save up this $100,000. His goal is pretty simple, but it's powerful. He wants to reach financial freedom by the time he's in his late 60s. But he's just frozen. He sees all the scary headlines every single day. Wars, oil prices going crazy, markets dropping, and he's just terrified to make a move. He wants a simple, steady plan, not some high-stakes gamble.
Okay, so how do we solve John's problem? We start by understanding, and I mean really understanding, the single most powerful force in all of finance. This is the engine that's going to do all the heavy lifting for him for the next few decades. We're talking about the compounding snowball.
So what is compounding? It's actually so simple it's beautiful. It's just the process where the returns your investment earns start earning their own returns. It's like a chain reaction. Your money makes money, and then the money that your money made starts making even more money.
The best way to visualize this is to think of a snowball. You start with your little snowball at the top of a very long hill. That's your one-time $100,000 investment. As it starts rolling, it picks up more snow. Those are your market returns. But as it gets bigger, it picks up way more snow, way faster. That's your returns getting reinvested and earning their own returns. After 30 years, that small snowball can become a totally unstoppable force.
Now, here's the thing. For John, and for you, there isn't just one single way to roll that snowball. It really all comes down to your comfort level with risk and what your long-term goals are. So we're going to explore 3 totally different paths, 3 different investment journeys he could decide to take, starting right now. All right, path number 1 is the most aggressive. We'll call it the total market blitz. This is basically putting 100% of the money into a broad market index fund, like one that tracks the S&P 500 or even the total U.S. stock market. The tickers you see here, VOO and VTI, are perfect examples. It's a super simple and powerful strategy, but you have to have the stomach for the journey. To be crystal clear, in a crisis like 2008, a portfolio like this could have dropped by over 37% in 1 year. The hardest part isn't picking the fund, it's having the guts to stay invested when things look really, really bad.
So how does this actually play out over time? Now, it is so important to remember, these are just projections. They're based on a historical average return of 10% a year. Your actual returns will definitely be different. But using that number, after just the first decade, John's initial 100 grand has already more than doubled, growing to over $250,000. That is a heck of a start.
But watch what happens in the next 10 years. This is where that compounding magic really starts to fire on all cylinders. The portfolio doesn't just grow by the same amount. No way. Because the snowball is so much bigger now, it grows by over $400,000 in this decade alone, bringing the grand total to more than $670,000. And finally, after 30 years of just staying the course, through all the market crashes and all the scary headlines, John hits age 70. And his single, one-time investment of $100,000 has transformed into an absolutely incredible $1.7 million. That is the raw, unfiltered power of compounding when you give it enough time to work in an aggressive portfolio. Okay, but that first pass is 100% in the US market. What if John's a little worried about putting all of his eggs in one country's basket? That brings us to path number 2, the global diversifier. Here, we keep a strong core in the S&P 500, but we also add an international fund to get that global exposure, and a tech-focused fund for a little extra growth punch. This spreads the risk out geographically, though you are swapping US-only risk for other things like global politics and currency swings. Because of this mix, the blended historical return is a little lower, around 9.65%. So after the first 10 years, the result is actually pretty similar to our first path.
John's investment still grows to just over $250,000, which shows that a little diversification doesn't mean you have to sacrifice that early growth.
By the 20-year mark, we start to see a small gap opening up compared to the all-U.S. strategy. But come on, the growth is still fantastic. The portfolio is now worth over $630,000 as all those different global assets just keep compounding together.
And the 30-year result for this global strategy? A very, very impressive $1.6 million. So here's the crucial trade-off. John potentially gives up about $150,000 in upside compared to the first path, but in return, he gets the peace of mind that comes with not being tied to the fate of just one single country's economy. And for a lot of investors, that is a very, very smart trade.
All right, finally, what if John is truly risk-averse? What if those scary headlines really get to him? Path number 3 is what we'll call the Sleep Well portfolio. This one is designed for preserving capital and getting steady growth by splitting the money between high-quality dividend stocks and the total bond market. Think of the bonds as a shock absorber for when the stock market gets all bumpy and volatile.
As you'd expect, the growth here is slower, but the journey is designed to be much smoother. With a blended historical return of around 7%, John's $100,000 still nearly doubles in the first 10 years, reaching just under $200,000.
At the 20-year mark, the portfolio gets close to $400,000. And this right here, this really highlights the core trade-off of this strategy. You are consciously sacrificing that explosive growth potential we saw earlier in exchange for a portfolio that's designed to have way lower volatility. It's about having a smoother ride, not necessarily the fastest one.
And after 30 years, even this most conservative path has turned John's $100,000 into more than $750,000. So let's be clear, even for the investor who just wants to sleep well at night, the end result is still completely life-changing.
So, what's the big takeaway from all of this? It really just boils down to a fundamental choice that every single investor has to make for themselves. It's that timeless relationship between risk and reward.
This slide just lays out that choice perfectly. On one end, you've got the aggressive total market path with its potential to hit over 1.7 million. In the middle, the global diversifier, offering a slightly lower 1.6 million, but you get less US-specific risk. And then finally, the conservative Sleep Well portfolio, offering a much smoother ride to a still incredible $761,000.
Seeing it as a bar chart just makes the difference so incredibly clear, doesn't it? The gap between the aggressive path and the conservative path is nearly $1 million. Look, there's no right or wrong answer here. There is only the answer that is right for your timeline, your goals, and your personal ability to stomach the ups and downs that will absolutely happen along the way.
So, the math is clear. The paths are all laid out. We've shown how one decision can set in motion a 30-year journey toward real financial freedom. John's journey could start today. The only question left is when will yours?